2,000 points. That's how much the Nasdaq swung on Monday, in a single trading session. And here's the part that should terrify you. Human beings didn't do this. Algorithms did. Machines trading against machines at speeds your brain literally cannot process. And your retirement account, it's caught in the crossfire. Stay with me for the next 8 minutes, because I'm going to show you exactly who's really controlling the market, how these systems are designed to take money from investors like you, and 3 specific moves you can make to stop being the victim. Let's get into it. First, let's talk about who's actually trading stocks in 2025. Because it's probably not who you think. According to data from the SEC and multiple academic studies, algorithmic trading now accounts for somewhere between 60 and 73% of all equity market volume in the United States. Some estimates for high-frequency trading alone put it at 50% of daily volume. Think about that. More than half of every trade happening on Wall Street right now is being executed by a computer program. Not a fund manager analyzing balance sheets, not a day trader watching charts, a machine. And these aren't simple programs. We're talking about sophisticated AI systems that can analyze news headlines, social media sentiment, order flow patterns, and execute thousands of trades per second. The average human reaction time is about 250 milliseconds. These algorithms operate in microseconds. That's 1,000 times faster. You're not competing with Wall Street traders anymore. You're competing with machines that can read, analyze, and trade on information before your brain even registers the headline. Now here's where it gets interesting. And by interesting, I mean infuriating. These algorithms aren't just trading alongside you. Many of them are specifically designed to profit from you. Let me explain. There's a practice called latency arbitrage. High-frequency trading firms pay millions of dollars to place their servers physically closer to exchange data centers. Why? Because being a few microseconds faster lets them see your order coming, buy the stock before your order executes, and sell it to you at a slightly higher price. This happens billions of times per day. A study from the Financial Conduct Authority estimated this costs regular investors roughly $5 billion per year globally. That's not a conspiracy theory. That's peer-reviewed research. But wait, it gets worse. Remember the flash crash of 2010? The Dow dropped nearly 1,000 points in minutes, then recovered almost as fast. The cause? Algorithms responding to algorithms responding to algorithms in a feedback loop no human could stop. Or how about December 2018, when Algos reading trade war headlines caused a 650-point drop in the Dow in a single day? Monday's Nasdaq chaos? Same playbook. One algorithm interprets data, makes a move, triggers another algorithm's stop loss, which triggers another's momentum signal, and suddenly you've got a 2,000-point swing that has nothing to do with actual company valuations. Your 401k just took a hit because a computer program in New Jersey disagreed with a computer program in Chicago. So what do you do about this? Because throwing your hands up isn't a strategy. Here are 3 concrete moves. Number 1, stop using market orders. When you place a market order, you're telling algorithms exactly what you want and letting them set the price. Use limit orders instead, every single time. Yes, you might miss some trades, but you won't get picked off by predatory algos hunting for retail order flow. Number 2, extend your time horizon. Algorithms dominate short-term price movements, minutes, hours, even days, but over months and years, fundamentals still matter. The more you trade, the more you're playing their game on their field with their rules. Warren Buffett's favorite holding period is forever. That's not folksy wisdom. It's a defensive strategy against algorithmic exploitation. Number 3, understand volume patterns. Algorithmic activity spikes at market open and close. The first and last 30 minutes of trading see the most algo-driven volatility. If you must trade, consider the midday hours when things are calmer. Not exciting advice, but effective. Here's the bottom line. The market you think you're trading doesn't exist anymore. The image of humans on a trading floor making decisions, that's theater. The real market is server farms and fiber optic cables and software engineers who've never read a 10K in their lives. This isn't doom and gloom, it's reality. And once you understand the game actually being played, you can make smarter decisions about your money. The institutions won't tell you this. The financial media glosses over it. Because admitting that machines run the market undermines the whole narrative that research and skill determine outcomes. But you're smarter than that. You watch this far because you want the truth, not the comfortable story. If this breakdown helped you understand what's really happening with your money, subscribe to this channel right now. I release videos every week breaking down the market mechanics, the wealth-building strategies, and the financial realities that actually matter. Hit subscribe, turn on notifications, and I'll see you in the next one.